Today, we embark on a fascinating journey to one of the most dynamic and rapidly evolving domains of our profession, taxation. As India's tax landscape undergoes sweeping transformation, it is both timely and essential that we pause, reflect, and engage with these changes in a meaningful way. I, Rakshita, feel privileged to welcome you all to Knowledge Session 2, Moolya, Tax Law in Transition, Understanding India's Changing Tax Landscape. This session promises to be enriching and thought-provoking, and it is certain each one of us will leave with valuable perspective and learnings. We are honored to have with us our esteemed chairperson, CA Sriram V Rao, along with our distinguished paper presenters who will share their insights on their respective topics. I now request CA Joyston to escort the chairperson of the session to the dais. Pranika Bhakta, Vice Chairperson of Mangaluru branch of SIRC of ICAI, to escort the paper presenters to the dais. Before we commence, it is my honor to formally introduce our esteemed chairperson for the session. CA Sriram V Rao is a partner at Nitin J. Shetty & Co., Mangaluru. He graduated in Commerce from Canara College, Mangaluru in 2005. Sir pursued his articleship under CAS Srinivas Kamath and was admitted as an associate member of ICAI in January 2013 and as a fellow member of ICAI in April 2018. He joined Nitin J. Shetty & Co. in May 2012 and became a partner in April 2013. Sir brings with him an impressive array of post-qualification credentials from ICAI, including the Diploma in International Taxation, Diploma in Information System Audits, and has completed multiple certificate courses covering concurrent audit of banks, forensic audit and fraud detection, UAE corporate tax, artificial intelligence for chartered accountants, and FEMA. Sir represents clients in appeal matters before departmental authorities, appellate authorities, including Income Tax Appellate Tribunal. His expertise spans direct taxes and international taxation with extensive experience in advisory and consultancy services along with corporate audits, tax audits, and bank audits. Beyond his professional practice, Sir has delivered seminars for income tax assessing officers at Mangaluru under a training program conducted by National Academy of Direct Taxes. He has also addressed members of ICAI across SIRC Chennai, Mangaluru, Udupi, and Kannur branch, and also conducted sessions for students at Mangaluru and Udupi SICASA, covering a wide range of topics in direct taxes and international taxation. In addition, he also serves as a visiting faculty in finance and taxation at several commerce colleges in and around Mangaluru. Sir, it's truly a privilege to have you chair this session. On behalf of Mangaluru branch of SICASA of ICAI and Mangaluru branch of SIRC of ICAI, we extend a warm and heartfelt welcome to you, sir. I now request CA Joyston to kindly present the token of welcome to our esteemed chairperson. Today's session features 4 presentations focused on critical aspects of India's evolving tax landscape. I'm delighted to introduce our dear paper presenters who will be leading us through insightful discussions. Our first paper presenter is Ms. Bhoomika M, who will be presenting the paper titled Overview of Income Tax Act 2025 and Key Reforms. Bhoomika is currently an article assistant at Shetty & Co., Balmata, Mangaluru. She has demonstrated exceptional academic excellence in her CA intermediate examinations. She was also a 10th rank holder in Karnataka State 2nd PUC examinations. Alongside her academic achievements, she served as a vice chairperson of SICASA Mangaluru for the year 2025-26, contributing actively to student and professional initiatives. Bhoomika exemplifies the perfect balance of academic excellence, professional commitment, and meaningful leadership. Next, we have Ms. Jahnavi S, who will join us with her paper titled Revised Capital Gains Framework and Tax Implication. Jahnavi is currently pursuing her articleship at Nitin J. Shetty & Co., Mangaluru. A well-rounded achiever, she was honored with the MAPS Achiever of the Year Award for the year 2019-20 in recognition for her excellence in academic and cultural activities. Beyond her professional journey, she is an accomplished Bharatanatyam dancer and a classical singer, having completed her Vidvat in Bharatanatyam from Karnataka State, Dr. Gangubai Hanagal Music and Performing Arts University. She has also been recognized as a B-grade artist in Bharatanatyam by Doordarshan, Bengaluru. Our third presenter, Ms. MVNSI Srija, will be delivering a presentation on the paper titled Global Tax Practices, General Anti-Avoidance Rule, BEPS, and Pillar 2. Hailing from Hyderabad, she has been an active participant in various SICASA initiatives and has earned recognition as the best paper presenter at both Hyderabad and Bhubaneswar national conferences. She also showcased her confidence and communication skills by hosting the jamming event as a jammer at SICASA event this year. Beyond her professional pursuits, Sai Srija is passionate about music and is actively learning Karnataka vocal music. Finally, we welcome Ms. Saloni Bajaj, who will be presenting her findings from the paper titled Taxation of Digital Economy, Influences, Freelancers, and Remote Work. Saloni is a CA final student and commerce postgraduate who has consistently demonstrated a passion for communication, creative expression, and impactful storytelling through her active involvement in presenting thought-provoking papers and student-led initiatives. Her experience in content creation further highlights her ability to present ideas in a structured and engaging manner. Driven by a keen interest in evolving digital tax landscape, Saloni brings valuable insights and a thoughtful perspective to today's discussion. Please join me in welcoming our lineup of exceptional paper presenters with enthusiasm and applause. I now request Sauparnika Bhakta, Vice Chairperson of Mangaluru branch of SICASA of ICAI, to hand over the token of welcome to our dear paper presenters. Without further delay, let's get started with our first topic. I invite our first presenter, Ms. Bhoomika M, to take the stage. Over to you, Bhoomika.
+4,000 amendments, 1,200 plus provisos, and nearly 900 explanations. These additions to the Income Tax Act 1961 do not represent a failed law. They represent a law that evolved continuously for more than 6 decades. A law that adapted to economic reforms, globalization, digitalization, and changing business practices. But somewhere along the way, the challenge was no longer to keep the tax law relevant, but it was to keep it understandable. And perhaps the real question was not whether the law needed another amendment, but whether it needed a new beginning. Good afternoon, everyone. Respected Session Chairperson, my fellow paper presenters, and all those present here. I am Bhoomika M, and I will be guiding you through the Income Tax Act 2025 and the key reforms introduced under it. The Income Tax Act 1961 served as the backbone of India's direct tax system. However, after decades of amendments, it had turned into one of the most complex and lengthiest tax laws of the country. It was against this backdrop that the government introduced the Income Tax Act 2025. Take a look at these numbers. In a rapidly evolving world, we generally expect every new version of something to become more sophisticated. Think of a smartphone. Every new model comes with additional features, updates, and capabilities. Yet, in our case, these numbers tell a very different story. The number of sections have reduced, the number of chapters have reduced, and the volume of the legislation is almost half of the old Act. So where did everything go? Were taxes abolished? Were provisions removed? Was the entire system rewritten from scratch? Not quite. Despite its significantly smaller size, the Income Tax Act does not fundamentally alter the India's direct tax system. Instead, what it attempts to do is something far more difficult. It attempts to make the same system much easier to understand. And it does so through a combination of simplification, reorganization, and modernization. Perhaps one of the most significant reforms is the replacement of the concepts of previous year and assessment year with the concept of a tax year. Meet Rohan. Now, he earned his income in the financial year 25-26. Under the earlier law, he had to identify the previous year in which he earned his income and then the assessment year in which the same income is assessed to tax. Now, this led to a lot of confusion among the taxpayers. And in order to solve this confusion, the government introduced the new act, and through the new act, they introduced the concept of a tax year. So now, income earned in the year 25-26 simply belongs to tax year 25-26. This concept of tax year is perhaps one of the most visible examples of simplification under the Act. But simplification here does not stop at terminology alone. It extends to the way the legislation itself is structured. One of the most important structural reforms under the Act is the reduction in cross-referencing. Meet Rohit here, who is trying to read a section in order to understand a particular issue. So from this section, he gets redirected to a proviso. From the proviso, he gets redirected to an explanation, and from there again to an exception located elsewhere in the Act. So by the time he reaches the end, he has read across multiple provisions just to understand one single issue, and this has left him confused. In order to reduce this complexity and improve readability, the government, what it did was it focused on logical grouping of provisions. One of the best examples of this is that provisions relating to non-profit organizations, they were spread across multiple chapters under the old Act. But now, they have all been consolidated into a single chapter, that is Chapter 17B, under the new Act. Then, we have the simplification has also extended to the drafting as well. Now, due to repeated amendments, the old Act had multiple provisos and explanations. Now, in order to reduce fragmentation, the new Act tries to incorporate these provisos and explanations directly into the main section. Now, simplification also extends to a point where the Act tries to simplify the language itself. And it tries to do this by changing a few of the words used. So, we all have come across words like notwithstanding, which has made us pause, reread it, Google the meaning of it, and take some time until we got used to the meaning. The new Act has tried to replace such words with words like irrespective of, which makes it easier even for a layman to understand. Now, we all have noticed that the new Act is much shorter, but a shorter law does not necessarily mean a less comprehensive law. The new Act tries to lose weight without losing substance. How does it do it? One way that it does it is by removing redundant provisions. For example, we had Section 80 HHC under the old Act, which provided for deduction for export profits. Now, this provision, it ceased to be available from assessment year 2005-06. Yet, for more than 2 decades, this provision continued to remain in the Act. So, such redundant provisions have been done away with. Another reform was the new Act has retained the substantive provisions within the Act and have shifted all the administrative and procedural details into the rules. For example, in Section 144B of the old Act, that is FACES assessments, the meanings of the word registered mobile number and registered email address were there in the Act itself. But now, such procedural details have been moved to the Income Tax Rules 2026. Therefore, the law has become concise, yet the important content still remains within the Act. Now, at this point, it is important for us to understand what the Act does not do. It does not bring a major change in the tax policy, nor does it bring a major change in the existing tax rate structure. In essence, the fundamentals remain the same. What has changed is only the way the law is organized and presented. Now, you all may be wondering, if the Income Tax Act 1961 has been completely repealed, then what happens to the pending cases, assessments, and appeals? Well, don't worry. Section 536 has got us covered. This section ensures that even the new act will continue to govern the future provisions, but it will not affect any matters relating to the earlier years. So existing rights, proceedings, and obligations, they will continue to be governed by the same framework that applied to it in the first place. Now, while the Income Tax Act is a significant step towards structural simplification, yet there are concerns about its long-term effectiveness and implementation. Because obviously, when a provision is redrafted, one natural question arises. Has the law itself changed, or have only the words changed? A practical example of this was seen shortly after the introduction of the Income Tax Act 2025. A post by a very popular social media account, it went viral, stating that now every Indian citizen would now be required to get an income tax clearance certificate every time they travel abroad. Now, this was not what the government intended. The provisions were the same as they were in the previous act. Yet, this created confusion among a lot of taxpayers. And the confusion gained so much momentum that the government had to step in and clarify that this claim was fake. What's interesting about this example is that this confusion did not arise because of a new tax policy. It arose because of the way the revised provisions were interpreted. Another significant issue or concern about the new act is the expansion of digital enforcement powers. Now, as tax administration is becoming increasingly digital, authorities are getting greater access to electronic records and digital assets. While this may strengthen enforcement, it also raises concerns about privacy and safeguards. Therefore, the Income Tax Act 2025, it tries to achieve what every legal reform aspires to achieve. That is, not changing what the law does, but changing the way that people understand it. And the answer to this question will not be decided by the text of the legislation, but instead it will be decided by the experience of the taxpayers who are going to use it eventually. Therefore, the real question that we should be asking is, can a simple law also become a better law? Thank you so much.
Thank you, Bhoomika, for that insightful overview of Income Tax Act 2025. Moving seamlessly ahead, let's now explore our next topic. I invite Ms. Jahnavi to take over the stage.
Suppose two investors have earned the same amount of return. Rahul invests in equity mutual funds and Sneha invests in debt mutual funds because she wants stability. Same investment, same return, yet the tax consequences are completely different. That is what brings to my topic, revised capital gains framework and tax implications. Good afternoon, respected session moderator, esteemed fellow presenters, and my dear audience. My name is Jahnavi S, and I will be leading you through the topic, revised capital gains framework and tax implications. What initially appeared to be a simplified tax structure has now started raising practical questions among investors, taxpayers, and even professionals. A simpler tax rate sounds beneficial, but what happens when indexation benefit is removed? A uniform structure sounds simpler, but does uniformity always result in fairness? Let's understand why was this reform needed. Prior to the Finance Act 2024, capital gains taxation in India was anything but simple. Multiple holding periods, varied tax rates, and selective indexation benefits. What did this lead to? compliance complexities, classification disputes, and even tax arbitrage. Tax decisions majorly became only tax-driven. Investment decisions became tax-driven rather than investment-driven. So the government came up with a revised framework. Now what was this framework? It reduced holding periods, revised tax rates, and even indexation benefit was removed. But does simplification in law always result in simplification to taxpayers? Let's try to understand this. The first major change was the change in the holding periods. As you see in the screen, the holding periods were divided into two buckets, that is 12 months and 24 months. Let's go through them one by one. First one being rates and InvITs. The holding period for long-term capital asset under rates and InvITs was been reduced from 36 months to 12 months. Similarly, for gold mutual funds and debt mutual funds which were purchased before April 2023, the holding period for it to qualify as long-term capital asset was reduced from 36 months to 24 months. And a major misconception. Many of them assumed that immovable property holding period was changed. But no, it is not that case. It was 24 months prior amendment and continues to be 24 months even after amendment. When it comes to unlisted bonds and debentures and debt mutual funds which were purchased after April 2023, they continue to be taxed at slab rates. Going further, let's see what changed in the revised tax rates. Coming to short-term capital gains under Section 111A, the tax rate was increased from 15% to 20%. Similarly, long-term capital gains under Section 112A was increased from 10% to 12.5%. But the threshold limit was also increased from 1 lakh to 1.25 lakhs. Let's try to understand how this impacts an investor. Imagine a trader who earns 5 lakh short-term capital gains. Under the old regime, he pays a tax of 75,000, but under the new regime, he pays a tax of 1 lakh rupees. 25,000 excess tax just because of the new regime. But this shows a clear policy intent, that is, to discourage speculative activity and to promote long-term investment. But the change only didn't seem here. The change was in Section 112. The rates were reduced from 20% to 12.5%. But what was the issue? Indexation benefit was removed. So what does it mean? Does a lower tax rate always mean lower tax? Let's try to understand this with an example. Imagine a company which has purchased a property in 2010 for rupees 20 lakh. And in the year 2025, the company sells the property for 80 lakh rupees. If you compute capital gains under both the regime, under the old regime, the company gets an indexation benefit and gets to pay taxes at 7.3 lakhs approximately. But under the new regime, the company ends up paying 7.5 lakhs, though there is a lower tax rate of 12.5%. So what do you think? The old regime is beneficial? But let's see another scenario. That is where the cost of the property is 10 lakh rupees. Now in this scenario, under the old regime, the tax appears to be higher, that is 11.65 lakhs, whereas under the new regime, it appears to be 8.75 lakhs. So comparatively here, the new regime seems to be more beneficial. So what do you understand from this? Where appreciation is going beyond inflation, in such cases, the new regime can be more beneficial. So this shows us one intent. Your holding period and also the extent of appreciation also shows a difference whether old regime or new regime can be beneficial. But when you looked at example 1, didn't you all get one question? Are we taxing economic gains or are we taxing inflation? The government also understood this hardship. That is why they inserted a proviso under Section 112. Now what is this proviso? This proviso is applicable to immovable property which is purchased before 23rd July 2024. And this is applicable only to resident individuals and HUFs. So if you take the prior example where I gave an example of a company, this proviso isn't applicable there. But let's take the same example, but assuming it to be an individual. And let's assume they have invested in another property amounting to rupees 35 lakhs, claiming exemption under section 54. Now, in this example, you calculate under both the regimes to claim the provision, to claim the proviso. That is, you calculate tax liability under the old regime as well as the new regime, and the difference between the tax liability will be allowed as tax relief. That is, if you see this example, the difference between 3 lakh and 30,000 will, that is 2,70,000 will be allowed as tax relief. That is, you end up paying lower taxes because of this proviso, but let's take a note. In your ITR computation, while showing your income, you will be showing 25 lakh, that is the income under the new regime only as your income and not 1.5 lakhs. Moving further, let's see how buyback taxation has evolved. When it comes to buyback taxation, prior to September 2024, buyback was being taxed in the hands of the company and not in the hands of the shareholders. But after the Finance Act 2024, buyback started being taxed in the hands of the shareholders, but the gross receipts was being taxed in the hands of the shareholders as dividend income, and the cost of the same was allowed as capital loss. This didn't seem right. That is why in the Finance Act 2026, that is from 1st April 2026, which continues under the Income Tax Act 2025, they will be taxed as capital gains income. Let's take a note here. Promoter individuals will be taxed at 22% and company promoters will be taxed at 30% here. Now, what are the categories impacted by this? Be it long-term property holders, young retail traders, conservative investors, and even NRI investors. And just a few days back, we saw an ongoing discussion with regard to long-term capital gains rate and STTs. That is when our Finance Minister Nirmala Sitharaman told that we are listening to the people. So what does this mean? Capital gains is still an evolving portion. It means it is a live policy conversation and not a closed one. With every evolution comes an interpretational issue. Now, I have taken such situation with an interaction with section 54 and 54F, which has also continued in section 82 and 86 of the Income Tax Act 2025. Imagine I have claimed an exemption under section 54. Now, I decide to sell that property within a period of 3 years, which causes my exemption to be reversed. Now, imagine that I again purchase another fresh property, which causes me to claim section 54. But can I claim a fresh 54 exemption when I am reversing my section 54 exemption? This is something we need to think about. And we being professionals, there is no certain clarifications with this regard. That is why when such cases appear, we might have to think about it before it turns into a dispute. We started our conversation with Rahul and Sneha. Same investment, same return, but different tax consequences. But as we walked through this, we understood that the gap existed prior amendment and also continues after amendment. Capital gains taxation merely depends on how long you hold, what you invest in, and whether the law and economic reality are completely aligned. Rahul and Sneha started this conversation. They are still investing, but what we need to think about is, are we taxing them fairly? I believe the answer is still being answered. Thank you.
Kindly note, the time taken by Jahnavi is 10 minutes and 11 seconds.
Thank you, Jahnavi, for shedding light on evolving tax landscape. Time to shift our focus to the next topic. Ms. Srija, you may take over.
Vandanagalu Mangaluru. From the lively lanes of Hyderabad to the welcoming shores of Mangaluru, I present my greetings with utmost respect. Myself, M. Srija, I am delighted to present my topic, Global Tax Reforms, in front of my session chairman, V. Sriram sir, my dear paper presenters, and this energetic crowd of Mangaluru. Now, before we start, let us understand the knowledge session number 2, Moolya for a minute. Imagine a company earning billions in one country while it is being taxed in another country for very low rates of tax. While the companies were going global and then digital, the traditional tax laws could not keep up with this. They had to introduce global tax reforms to avoid profit shifting and to ensure these incomes were taxed where businesses were actually taking place. And we are here today to understand the global tax reforms which have been closing the gaps between any loopholes being exploited by the taxpayers. Now, I need a very small help from you before I begin my presentation. Since my presentation was after the lunch hour, I was kind of worried that even to my dabba voice, you all would fall asleep. So I need you all to come with me to this presentation, just like in Jumanji movies. How many of you know the Jumanji movies with Rock, where there's a video game and 4 people get pulled inside the video game and they have to live in the jungle until they solve the issue? How many of you know of it? Nice. So I need a small help from you. When I say 1, 2, 3, go, I need all of you to make the loudest snap that you can. You understood it, right? Let me count. 1, 2, 3, and go. Once again, Vandanagalu Mangaluru. Let me take you through not just the presentation, but the game of global tax reforms. Now, myself, M. Srija, here with you, taking you through the whole game, while you, representing your future selves, a CA, the mini tax officer. The rules of this game are really simple. We have a Mission Impossible briefcase consisting of very hard cases to solve. And once you solve case number 1, 2, 3, you get a trophy. Voila! That, my friends, will begin the game. Now, let's start with file number 1, Tax Kshetra. I know it's not winning any naming awards, but I just wanted to represent Kurukshetra. Taxation these days feels like a battlefield of rules and then exceptions and finally ending up still with the conflicting interpretations. Now, when this goes global, let's understand. In Tax Kshetra, there's 3 friends, Mr. Dharmaraj, Duryodhan, and Shakuni. When they sold the stake in their businesses, they earned 50 crore each. What Mr. Dharmaraj has done with his money is that, being a family man, he purchased a house worth 20 crore for his family. Then Mr. Duryodhan was being too smart and took the entire money in cash, thinking nobody would know. Then what Mr. Shakuni did was that in a trust he recently created with his family members and close friends as his beneficiaries, he has transferred the entire shares to the trust, and the trust has received the total net sale consideration. While Mr. Dharmaraj received appreciation while filing taxes and claimed an exemption under 54F, just as Jahnavi has mentioned earlier, Duryodhan has got a notice from income tax department because he was being a silly cat, closing his eyes and drinking the milk, thinking nobody would notice. But everybody listening to this case was totally confused about what to do with Mr. Shakuni. As per the papers, as per the laws, it was completely legal, but something didn't feel right. Then you, my dear friends, as tax officer, has told about GAR, General Anti-Avoidance Rules. What happens in GAR? You told that we have to check whether this situation is an impermissible avoidance agreement or not. First, you told us to perform the main purpose test. What Mr. Shakuni has done, what was the purpose of it? He wanted to avoid the taxes. He didn't want to pay the taxes within for the entire 50 crores. So he split it between his close relatives whose tax brackets were really low. So you understood the main purpose test, through the main purpose test, that this was for exploiting and paying less taxes. Then you conducted the commercial substance test. Was the trust really for helping the others or for any good purpose? No, it was only formed just to avoid paying the taxes in this case. Since failing both these tests, you have confirmed that this is not legal in fact. Now, I heard today morning in the news that to get the full picture about everything, you have to know all the sides of it. Just like a dice still has 6 different sides, every single reform also has its good, bad, and the neutral facts. First, starting with the neutral one, GAR, General Anti-Avoidance Rules, apply to any arrangement only when the tax benefit exceeds 3 crores. Like how in 50 crores when it was taxed at LTCG for 20%, only if the tax benefit exceeds 3 crores, then the GAR can be applied in this case. But there's also a bad side to this. Since GAR, the name itself specifies it being general, it covers so many different cases where a taxpayer, even if he thinks of planning his taxes properly, it somehow may end up hitting the rules of GAR. But also, the good thing about GAR is that even though we have SAR covering so many specific rules, like a specific case of clubbing of income, we still have GAR which covers any rule, any exploiting agreement which doesn't come under SAR. With this, you have completed level 1 and got 1/3 of your trophy, my dear friends. Now going to the second file, profit on vacation. Here we have 2 companies, S Limited and A Limited. I'll give you a clue. What's S Limited? You have to tell me what's A Limited. S Limited stands for Sauparnika Limited. And we have A Limited. What do you think it stands for? Abhishyam Limited. So, S Limited was a very big company in first country. It had earned so much of money by doing proper business and with very skilled employees and using all the resources in the first country. But it also has an associated named Abhishyam Limited in another country. This company, Abhishyam Limited, had not much business going on, just here and there, few administrative tasks and so on. Now, what happened is that at the time of tax filing, there was a very important question. As you can see, all the profits were with S Limited. Now, Sauparnika, in their annual general meeting, was about to announce who is going to pay so much of taxes. Everybody thought it was Sauparnika Limited. But she gave the twist that it was Abhishyam Limited. Everyone was so confused. What happened? How did this happen? Then once again, my dear friends, you have come and told about the case of base erosion and profit shifting. This is a case where profits are shifted from one company to other company through illegal routes, and which can be stated in the name itself. The base country is being eroded of its taxes and the profit is being shifted to another country. When so many of these cases had taken place, OECD, Organization for Cooperation and Development, along with these affected countries and many more countries, had come up with action plan having its main goal that profit should be taxed where the economic value is created and not on a vacation country. Now, once again, BEPS project had an action plan which included 15 points, each point specifying multiple rules to avoid these base erosion and profit shifting. But the bad side of it was that countries itself started a race to the bottom. They started reducing their own tax rates just to attract other countries. This eroded the taxes for high tax jurisdiction countries, while low tax jurisdiction countries started to settle for lower and lower tax income, which would in fact reduce the overall development of a country. But also, BEPS has few very wonderful measures. Like in BEPS Action 13, there's CBCR, company by company reporting. Tax department, to make multiple rules and amendments or reforms, it needs to understand what is the situation that is taking place. Company by company reporting ensures that all these large multinational groups provide all the data of the revenue, profits, taxes to the tax authorities so that it understands the profit shifting risks. Now, going to the third. Computer G, please present your questions. There were so many questions regarding what tax to be paid, how much tax to be paid when the BEPS took place. You told about Pillar 2. This was introduced in BEPS OECD 2.0, where pillar number 1 solved the question of where the taxes should be collected, and pillar number 2 solved the question of how much should be taxed. This pillar 2 solution came up in 2021. The pillar 2 tells that every large MNE should pay 15% of global minimum corporate tax. It applies to MNEs with annual consolidated revenue above 750 million only, leaving out so many small cases where it's being exploited. But the good side is that even though GAR has told not to do profit shifting or illegal tax structures, BEPS pillar 2 tells you that minimum tax should be paid wherever you run. With this, we end with the third topic, pillar 2 also. That was my presentation. Thank you for listening.
Thank you, Sai Srija, for that engaging presentation. Now let's advance to our next topic. Over to you, Saloni.
Attention, attention, attention. The fact that almost all of you looked up when I said attention proves one thing. Attention is the most powerful currency in this today's digital world. So, before I begin, let me introduce you to someone. Say hi to Ria. She is a 24-year young girl. She has an Instagram account, a laptop, a great internet connection, and what her parents still called phone key addiction. Last month, she earned from Instagram collaboration, edited a video for a client in Dubai, and started working remotely for a company in New York. Now, my question is Ria an influencer, a freelancer, or a remote employee? Because in this today's digital world, one person can be all three. Hello everyone, I am Saloni Bajaj, a CA finalist from Surat, city famous for diamonds, entrepreneurship, and people who can even discuss business opportunities during dinner. Today, I'll be presenting my topic on taxation of the digital economy, influencer, freelancer, and remote work. And through Ria's story, let's see how taxation is adapting to a world where income is not only generated through offices, factories, or shops, but also through smartphones, laptops, global networks, and social media platforms. For decades, the business has a particular structure. You opened a shop, you hired employees, you sold a product, you earned income. Taxation was relatively straightforward. But today, a person sitting in Surat can earn from New York. A person, a freelancer, can edit videos for 5 countries in a week. And an influencer can earn from a brand even without receiving a single rupee in cash. So, what do you think? What they are all doing? Is that an influencer thing? So, it is like, this is called digital economy. Let's come back to Ria. She posts fashion and lifestyle content on Instagram. One day, a smartphone brand approached her to collaborate for an iPhone worth rupees 1 lakh in exchange of a promotional reel. Naturally, Ria is excited. She uploads a story on Instagram saying, "Hey guys, I've received this iPhone as a PR package." From an influencer's perspective, this might seem like a gift. But from taxation perspective, this is a taxable benefit. So, here comes section 194R. We see that taxable benefits is a taxable under PGBP because nothing is as free as we see on Instagram. As once Shah Rukh Khan said, "Koi dhanda chota nahi hota." And if income tax department had a sequel dialogue for it, it would probably be, "Koi income choti nahi hoti." Now, Ria's content become popular. A luxury hotel stays her with a collaboration that no money will be exchanged. Hotel gets the publicity, Ria gets the accommodation. Sounds simple, right? Not really. Because under GST, even barter collaborations can have tax implications. So taxation is must. Now see, many people sitting in this room might think like freelancing is easy. Just like many people thought, CA students thought that AFM paper would be easy in May 26. In both the cases, the reality arrived unexpectedly. But we were on RIA. So RIA starts freelancing and soon gets client from Canada, UK and China. Now, soon she gets clients from it. So her laptop became her job. The marketplace became her world. This is the beauty of freelancing. No proper dress codes, no formal geographical barriers, and no office rent. Because the freelancing income is also taxable as PGBP. So now RIA needs to think about maintaining records, claiming deductions, selecting appropriate ITR forms, and understanding the GST implications. And that is where most digital creators fails. Because earning income from social media is comparatively easy than understanding tax implications. So, another practical question arrives is that, which ITR form should RIA file? ITR 3 or ITR 4? So, if she opts for presumptive taxation income under section 44 ADA and prescribed conditions are satisfied, she has to file ITR 4. But if not, she has to file ITR 3. Then comes the main thing. Ria's income was growing. She thinks, ITR to main July mein file karungi. But taxation has a surprise waiting, advance tax. Unlike salaried employees, freelancer has to income tax and paid it in the same year as it earns. So, while she thinks she will file in July, it has not happened. If she doesn't file the income in the same year, section 234B and 234C will apply with interest liabilities. Now, let's make Ria's life a little even more complicated. She accepts a remote work from a company based in Dubai. She lives in India, works for Dubai, collaborates with the clients in Canada, and receives income through international banking channels. At this point, even RIA needs a CA because taxation has become global. But the main question arises, which income is taxed where? Which income is taxed where? What is her residential status? Will DTAA provisions will apply? Or can double taxation occur? This is where the digital taxation becomes unique. This is where the digital taxation becomes unique. Now, we see that we have seen RIA being an influencer, freelancer. But in today's digital world, we already have something which is way far better than this. Like AI-generated content, virtual influencers, creator economies, digital assets, and platform-based businesses. So, if tomorrow a new income will generate, taxation must have to evolve too. Because the future taxpayer may not have a shop, a factory, or an offices, but they might have a smartphone, a laptop, and an audience. So, as I would like to conclude, I would say that in the beginning of the story, we see that the RIA is a girl having an iPhone, having Instagram account, a good internet connection. But till the end of her story, she has become an influencer, a freelancer, and a professional remote worker. So, what is all this? Before I would like to leave you with one last thought, I would like to show you something.
As someone who enjoys creating content myself, this reel took me 15 seconds to shoot, 30 minutes to edit, 2 hours to overthink, and if this becomes a brand collaboration, few tax implications too.
Because in the digital age, attention becomes influence, influence becomes income, and income becomes taxable. Attention, attention, attention. And that is why the digital economy is real. Thank you. Signing off, Saloni Bajaj.
Thank you, Saloni, for shedding lights on taxation in digital era. We extend our sincere appreciation to all our paper presenters for their thoughtful research, valuable insights, and commendable presentation. A huge round of applause to all our paper presenters. Every great session is enriched by the perspective of an experienced guide. It is now my pleasure to invite our session chairperson, CA Sriram V Rao, to share his observations and concluding remarks on today's presentation.
Good evening, everyone. First of all, I would like to congratulate Mangalore branch of SIRC, SICASA. So they have, conducted this national conference. When I was a student, we never used to have conferences like this or student seminars. Very rarely, maybe 1 or 2 in a year. And when I became student or articles or continuing my articleship for the second year to third year, that time we had SICASA in Mangalore. For the first time we started conducting programs for our students. So this being the case, now you people are getting a lot of exposure than what I used to get when I was a student of this esteemed profession, chartered accountancy. So for Mangalore branch, I congratulate to conducting UDGAM. So for the benefit of all the CA students, national conference, and I'm happy to see that more than 1,000 attendees are attending these sessions. That's first of all, that's one thing. Second thing is I've come to these kind of national conference of SICASA many a times as a session chairperson. Once I completed my professional course after 2013, 14, etc. And every year I have been seeing that lot of students are coming forward, and especially girls. And now in my session of 1 hour, it was all 4 girls took topics of different character within income tax itself. I would like you all to give a big round of applause for them. A big effort made by all 4 of them presenting these topics. Actually, in fact, these are very, very complex topics, and in my CA journey since 2008 to about 18 years, continuously I have been practicing and more focused about income tax, international taxation, consultation, litigation, and compliances, etc. And I have seen a lot of reforms that has been happening over the years. And the recent one being the entire change or repeal of the old Income Tax Act 1961 and introduction of the new Income Tax Act 2025. This is how we started the session today by the name Moolya. Moolya means value. Correct? Moolya means value. This is the name of this session on income tax alone. So we have to value our asset, anything and everything around you, then only you will know how worth it would be in your life. And with the changing environment over the past 18 years, and that too, the changes are happening very fast, very quick. So Bhoomika has taken topic on Income Tax Act 2025. She has, in my view, she has done a very good job by summarizing the entire amendments or changes that has taken place in the Income Tax Act itself within a span of 10 minutes. And in fact, it is my sincere request to the Board of Studies. I think they have designed this national conference for the students. Maybe the intention is that lot of different topics has to be brought into the knowledge of the students. But it is very unfair on anybody to tell come and speak for 10 minutes on a particular topic and do justice. Very, very difficult. And that too on technical topics. And all four of them have done a good job in presenting their papers. Let me go and look into each and every one's presentations. First of all, Bhoomika did on Income Tax Act. She has tried to articulate in a very simple manner whatever the changes has happened and done a very good job. Then Jahnavi took a topic on capital gains. In fact, capital gains is a very fond topic for me from income tax perspective, because it is very challenging and we can have a very good tax planning practices if you are very, very studious and understanding of each and every language that is involved. So in that respect, she has touched upon a lot of changes that has happened in last 2-3 years in the income tax capital gain provisions, and good job done by her as well. Now comes to the BEPS, GAR, and one more is BEPS, GAR, and you took? Yes. So these three topics are relating to more on international taxation. International taxation is actually nothing of your understanding about foreign tax laws. It is more of understanding the Indian Income Tax Act in collaboration with what is happening globally and how in this digital economy or in this digital world the taxation will happen on a particular type of income. In fact, the topic of Saloni as well as Srija should have been merged together and they should have put up the paper together, because the influencers or the freelancers and the work from home, remote work situation, and the BEPS action plan, pillar 2 as well as your GAR, they would go hand in hand. Maybe one is affecting more on individuals' taxations, which is influencers and digital economy taxation or virtual digital asset taxation, etc. But BEPS and pillar 2 as well as GAR have more impact on the companies or corporate sector as such. But these are topics which are more very much alive topics and ever changing, and it is very challenging because ಕನ್ನಡದಲ್ಲಿ ಒಂದು ಗಾದೆ ಉಂಟು, ಯಾರಾದರೂ ಚಾಪೆ ಒಳಗೆ ಜಾರಿದರೆ ಇನ್ನೊಬ್ಬರು ರಂಗೋಲಿ ಒಳಗೆ ಜಾರ್ತಾರಂತೆ. ಹಾಗೆ ಗೌರ್ಮೆಂಟ್ ಚಾಪೆ ಒಳಗೆ ಜಾರಲಿಕ್ಕೆ ನೋಡಿ ಏನು ಚೇಂಜಸ್ ಆಗಿದೆ ಬಿಸ್ನೆಸ್ ಎನ್ವೈರ್ಮೆಂಟಲ್ಲಿ, ಬೇಸ್ಡ್ ಆನ್ ದ್ಯಾಟ್ ದೇ ಆರ್ ರಿಫಾರ್ಮಿಂಗ್ ದ ಇನ್ಕಮ್ ಟ್ಯಾಕ್ಸ್ ಆ್ಯಕ್ಟ್ ಆರ್ ದ ಟ್ಯಾಕ್ಸೇಷನ್ ಲಾಸ್. Now it is up to the businessman to think differently and go beneath the rangoli and change the entire dynamics of the business, because the business dynamics have been changing, especially after COVID. You might have seen that no more traveling. Everybody is sitting in their office and doing work without traveling. They are not relocating themselves, isn't it? So these are all the challenges that has come up now. So how to tackle this? That is the government perspective. So they both have actually, it's a very, very complex topic. Let me tell you, I am very much enthusiast as well as practitioner in international taxation. I have read OECD guidelines on BEPS action plans, and I have read almost all the papers or commentaries in respect of BEPS. And I know how complex it is. And she has tried her best to put it in a very subtle manner so that you people understand. And again comes to tax planning on influencers. Of course, it's a very learning curve for everybody, including me. Because the influencers taxation or freelancers taxation, remote work taxation, they are, day-to-day practice for us. Henceforth is going to be that only for anybody and everyone. if you want to practice in income tax. So you have to be, concluding all the 4 topics together, what I would like to state that if you are trying to practice income tax or any other law or anything in after you completing your chartered accountancy, you must be very thorough with the concept of any one area of your practice. That is where you can be, having the grip over your practice, right? So the CA journey nowadays, especially nowadays, because when I was studying, it was totally different era. No online classes. We have to go to some physical classes of, for studying our CA finals or CA inter as well. So very limited options. Now you have lot of, online classes for studying, etc. So you are more focused on your academics. In one way it is good, you will clear your CA as soon as possible. But it is also very important when you are academically pursuing your CA course, you also have to be keeping in mind that CA is a professional course. So conceptually you have to learn the subjects as well. You have to be conceptually strong. To be conceptually strong, your articleship will help. So be very, very attentive and give full heart in your articleship. Now that too, it has been reduced to 2 years from 3 years or 3.5 years, which Tarun was talking about. So with this, I would like to conclude my talk, otherwise bell will start ringing. So all the best and very well done all 4 paper presenters for this session of Moolya, and hope the knowledge has been enriched at least with some amount of inputs that you got on all these 4 topics. Thank you.
Thank you, sir, for your valuable insights and guiding this session with such expertise and grace. As we draw curtains on this knowledge session, I extend my deepest gratitude to our esteemed chairperson, CA Sriram V Rao, and to all our paper presenters for their outstanding contribution. I now request CA Daniel March Pereira, Chairman of SIRC of ICAI, to hand over the token of gratitude to our dear chairperson and the paper presenters. Thank you, sir, once again.